For more on that, let's bring in Greg Branch. He's managing partner at Veritas Financial, and Lisa Erickson, who is the head of the traditional investments group at U.S. Bank Wealth Management. And Lisa, let's start with you because you're optimistic. You say you're looking at things glass half full. Why is that?
Absolutely. Well, we're really positive on the market, mainly because if you look at both the top down and the bottom up fundamentals, what we see is really a robust picture. So we've got a situation where most macro indicators are in solid absolute levels, as well as good ongoing trends. And then if you look at the second quarter earnings report, we really have had a very nice spate of earnings releases. And in addition, if you look forward, the full year forecasts continue to stay stable and or rise. So that really is a great fundamental backdrop for continued projection of upward stock price movements.
Hey, Greg, you've been watching the Fed, and I know what they did last week surprised you a little bit. You maybe thought that the Fed would be forced to act sooner than it looks like they're going to.
Right. From a strategic perspective, I thought those great second quarter earnings were an opportune time to do what we know they have to do eventually, and that is capitulate that the labor market no longer needs accommodative monetary policy and that the danger to the economy at this point is inflation. And so, as Lisa said, in the second quarter, we saw 83% of companies beat their top line expectations and 86% of companies beat their bottom line expectations. I expect the third quarter to be similar. The problem is between here and there, the market is looking for something to focus on, as we see by the sideways activity. It's not to discount the multi-year growth story. I certainly concur with that. But we do have some acute dangers in the meantime. Namely, I worry that we continue to grow the labor market in terms of the supply of jobs faster than we are growing the availability of workers. That will keep wage pressure high. I worry that we've added stimulus in the means of the SNAP program, where we've supplied $20 billion of additional stimulus, and we've allowed states to recapture and repurpose some of the American Rescue Plan to extend generous unemployment benefits.
Although, Greg, I don't know any states that are actually doing that. New Jersey
not yet.
Has the fifth highest unemployment rate, and our governor said, no, that's not going to happen. That's not appropriate.
And we'll have to wait and see. But at the end of the day, that's going to prevent the type of bounce back that we were expecting when those generous benefits roll off, if some states do choose to employ that. And we also haven't yet seen Delta have a deleterious effect on the labor market. We've continued to have pandemic low jobless claims, but that presents a risk as well that job growth will continue to outstrip our supply of workers, providing a very non-transitory form of inflation in the way of rising wages.
So you think that in a couple of months, when we start seeing results for the third quarter, it will be enough to make Wall Street have faith in it, but between now and then, you're not sure what happens to stocks, or you think that they wobble from here?
If the Fed drops this on us in September, we're past the earnings reports and the positive surprises, and that's the sole thing that this market's going to focus on. To those who say that this is priced in, I hearken back to a week and a half ago when those Fed notes dropped and we promptly lost 900 points over the course of 2 days. It's not priced in until the Fed is definitive on what they're going to do, and if that happens in September, where we're between second quarter and third quarter earnings reports, I do worry about a pullback.
Lisa, what do you think about that? You think the Fed can finesse this as they have to this point, or you think it's rougher sledding once they actually start doing the taper? I mean, we lost 900 points over 2 days, but we're sitting at all-time highs right now.
Well, to your point, Becky, the Fed actions really are going to have a key influence on the market. What we see so far, though, this year is that markets have really reacted fairly well to the messaging, including Chair Powell's speech last week at Jackson Hole. And what we're hearing really overall is a message where they do believe that they want to continue to support the market and ease into some of that tapering and ultimately some rate increases, but in a very supportive way. So overall, it really appears that the Fed has the market at its back. And so that, again, is helping to contribute to some of the optimism that we have on the markets going forward.
Hey, Greg, let's talk about some of the stocks that you like. Financials were the best performer for the month of August. You think that will continue this month?
Yeah, and look, I think it will be bifurcated until we see an imminent betterment of the net interest margin environment. I'll continue to favor those big conglomerates that have capital markets at their back, that have advisory fees at their back, that have issuance at their back, because that's really been driving the performance when you look at the Goldman Sachs, the Morgan Stanleys, the UBSs of the world. And I'll continue to favor those because we've seen with this liquidity and the high currencies, we've seen a spate of activity much like we haven't seen in the last 2 decades. When we see evidence that the net interest margin will start to improve, I think that I'll go broader in the sector. But this is no longer a valuation trade. You know, the valuations we saw a year ago, 9 months ago, where some of these were at less than tangible book, were crazy. But at this point, it's a bet on the earnings continuing to see consistent earnings growth.
And Lisa, you're overweight on the U.S. large caps. So why is that?
We really like emphasizing U.S. equities, mainly, again, because of this very positive macro backdrop, as well as the monetary accommodation that we've talked about earlier. And then if you look more broadly at the global environment and we check our health checks, whether it's in developed economies globally or emerging economies, we see very similar trends. And while the pace is not exactly the same around the globe, what we see is continued reopening activity and recovery. So that, again, provides a very nice backdrop for our companies, particularly the larger ones, to continue to do well.
Lisa, Greg, want to thank both of you. Good to see you this morning.
Glad to be here.